For now, let's continue the conversation with our market panel. Joining me now is Charlie Bobrinskoy of Ariel Investments and BNY Mellon's head of investment analysis, Jake Jolly. Guys, good afternoon. Charlie, there's so many disconnects here. People seem to be feeling pretty good about the economy, but talking really bad about it at the same time. Small caps not performing today. What do you do? Anything different than was your game plan heading into 2024?
I think we've been consistent, John. I think we've talked about the fact that we had a pretty big rally at the end of last year, and that took stocks from being underpriced and being great value to being fairly priced. I wouldn't say we had a bubble in small cap value or mid cap value. We probably did have overpriced stocks in large cap growth. Now, what has changed, and which I don't think has gotten enough publicity in the last 2 or 3 days, is China. China had the lowest growth rate that it's had since probably 1990. They've had a drop in population. They're rattling their sword around Taiwan, which would not be good for the markets. So I think things are a little soft in China. China's been a source of global growth, and that news has hurt some parts of the economy.
Okay, now, Jake, tell us your market thesis here and the challenges to it. Is 2024 playing out as you expected?
Well, it's pretty early, so I won't, jump the gun here too much. But I think, pretty clearly the market got a bit ahead of itself with the everything rally in the last 2 months of last year. Obviously, a large part of that was predicated on, this pivot. It was very aggressive, the moves that we saw in yields. Now we're seeing a bit of a backup. We're seeing markets needing to reprice those expectations, particularly around the March cut that was priced in pretty aggressively. That's been repriced as of today. I think, we're closer to 50-50 for that first cut coming in March. I think that's much more reasonable. I think when we were pricing in that 80% probability, that was way too aggressive. And certainly now we're getting to something that's probably a little more realistic. This is a market that is still very, sensitive to expectations around what the Fed is going to do. So unfortunately, that means that those kind of repricings based on, a package of data today that was by and large pretty decent, from the housing sentiment that we got, from the beige book, from retail sales, all of those things need to be digested by this market. And that's certainly, making the outlook still pretty difficult to read.
Okay. Charlie, you say that small and mid caps are fairly priced, whereas the large caps are overvalued, and China, as you mentioned earlier, is the risk. So do you sort of average in particularly to certain small and mid caps that are not overly exposed to China?
Yeah, that's one of the beauties of small and mid-cap stocks is they tend to have less international exposure, less exposure to China. So, for example, we have building product companies like Mohawk that makes carpets for homes. There are a lot of those stocks that are very attractive. There are parts of the U.S. auto business that is very attractively priced. There's still a lot of pent-up demand for cars and homes, and those things are not going to be hurt by less demand in China. And frankly, they get helped when there's less growth in China. That can soften commodity prices, which can be good for those companies that I mentioned. So we would emphasize small and mid-cap value. Obviously, that's our business, so I probably have a bias that way. But objectively, we do think there's more value there than large cap growth.
Jake, what can we learn from these financials earnings, particularly the regional banks?
Yeah, I mean, look, the earnings season is obviously very critical. We need to keep it in context that Q4 was still a pretty strong quarter in terms of the economic backdrop. We are expecting that there was a slowdown in growth, but, as I already mentioned, the package of data that we got today is suggesting that growth was actually probably a bit stronger than we expected. Downward revisions to the Q4 earnings mean that it's probably going to be a pretty strong earnings season in terms of beats. However, really, we all know that the most important thing is guidance for 2024. What are companies thinking? And, coming into Q4, the trend or coming out of Q3 season, it was weak demand, weak demand. That was really what you were hearing. Whether that sort of continues to be sort of the main narrative, I think is going to be critical. And obviously the health of the regional banks, right? Are they still underwater? Are they going to be able to come back? That is really sort of the heart, the bread and butter that keeps sort of the economy going. So if they continue to struggle, it's probably a sign that the boots on the ground are struggling a little bit.